Brad, what on earth is going on?
Morning, Rish. Yeah, I think the saying that if you wanted to come back as the most powerful force in the world, you'd want to be the US bond market remains the theme. So investors, whether they are at the Asian investment grade credit market, as you mentioned, or various other parts of the financial systems, are responding to this rise in US rates, and it's clearly causing some volatility, with one notable exception, which I'm sure we'll talk about later.
Tell me about that then. We can talk about it now.
Okay, so the Chinese government bond market, if we look at our Bloomberg screens and see where all other bond markets have gone with respect to the US bonds, they've been dominated by the rise in US rates. China rates, on the other hand, have been dancing to their own tune and have been broadly stable over this quite volatile period. So for investors who are looking at a diversified portfolio of bonds, the Chinese market has absolutely provided that diversification. It had its rise in yields in 2020 as China was sort of first in, first out of the virus, and now we're seeing that play out in the US.
Yeah, arguably, yeah, earlier in the cycle right now, Brad. The thing is that also with that comes this draw of liquidity that many people are seeing, and people are suggesting that there could be further liquidity taken out of the Chinese system. What impact does that have?
I think that, interesting, the comments out of the NPC with such a low growth forecast for 2021 is almost mathematically almost impossible to get to 6%. The US possibly growing stronger than that this year. And I think some of the wobbles we're seeing in Chinese equity markets and maybe Asian credit markets are not just driven by the US bond market. It could well be that markets have interpreted this sort of cautious growth forecast coming out of China as a signal that policymakers in China won't be providing as much stimulus as markets are always keen to see, and are focused on sort of restructuring their economy and making sure that their leverage ratios don't continue to grow. So that's actually a positive, I guess, for the defensive markets in China, such as the bond market, but the growth-oriented markets might have been a little bit disappointed by that outcome.
Brad, how much worse can it get for the bond market? I mean, Treasury yields, how high can they go from here?
No one knows, but the bias, I think, for now is clearly upward, and it's clear that whether it's Secretary Yellen or Governor Powell are really not providing any comment that would suggest that the yields they're going to be pushing back against this rise in yields. And as long as it's supported by economic recovery, inflationary pressures continuing to rise somewhat, whether that's base effects or something more sinister, for now I think the bias is for higher yields. And I think we're likely to see this stepped effect in yields. So we've gone up to sort of this 1.6%. That's been quick. And maybe cause some volatility in equity markets. We potentially stabilise here for a little while. And then once the market gets comfortable with this level, I suspect we're heading to the next level, maybe towards 1.75. Looking further out, typically in a rebounding economic recovery, you would particularly think about US 10-year bonds towards 2.5% or even higher. But given what the Fed's doing with respect to its bond purchase programs and all these other initiatives, we're not expecting bond yields to rise as much as they have done in previous cycles.
Brad, just want to get to, they've got this line just coming through. It's the national team, as some people call it. China state funds are set to buy stocks after this plunge escalated for equities. So we've seen a big turnaround take place. Are you also, when you look at what happens here on the equity markets, do you see that sort of behavior also coming in and supporting the bond market and credit markets in particular looking ahead?
That's an interesting question. Will the PBOC start doing QE? And I guess intuitively you'll think, well, no, not yet, because they've got plenty of room to cut rates. But ultimately, China has a sort of a money growth target. And in order to achieve that target, they can cut RRR, they can have other measures, but one method they could use would be to expand their balance sheet by QE purchases. We don't think that's likely anytime soon, but it is certainly part of their toolkit. And even though the PBOC is been making sort of quite hawkish comments lately with respect to a focus on deleveraging It could well be that in the future we do see the PBOC embarking on some sort of bond purchase program, and that's been central banks globally have been doing that for many, many years now. Even the Bundesbank was doing it back in the 70s.
Brad, when it comes to the yuan, the PBOC has also made clear it wants a stable currency. The yuan has now given up all its gains for the year. What do you make of that?
Yeah, in our mind, the yuan is a long-term appreciation story. If you think about China's productivity growth relative to the rest of the world and the US, it's growing strongly, and that's likely to be supportive of a stronger currency. Policymakers are looking to internationalise the currency, so they'll be looking to attract foreign investors and show that it is a great store of wealth and return. So those longer-term forces for the renminbi are still there and are very, very powerful. Cyclically, we've also got some sort of quite strong portfolio inflows. I'm sure a lot of investors are worried about the outflows from emerging markets that are occurring in recent sessions. That's not happening in the onshore China bond market. That flow is going to be quite strong. Let's also not forget that Chinese export growth has been very, very strong, and exporters receive US dollars and convert some of those US dollars to renminbi. That conversion ratio has actually been quite low in recent years. If that was to return to a more historical average level, it won't just be the foreign investor that's supporting the renminbi, it'll be Chinese exporters themselves converting their US dollars to renminbi. So the renminbi won't be immune to a powerful short-term move in the US dollar. I would say that the renminbi's outperformed its trade-weighted basket, so it's outperforming most other currencies. But over the longer term, we do see room for the renminbi to appreciate versus just about every other currency.